Welcome back, everyone, to Vox Markets. My name is Paul, and I'm delighted to be able to speak to Richard Penny of Crux Asset Management, one of the UK's smartest small and big cap investors. So welcome, Richard.
Right, thank you. Good morning, and thank you for the introduction.
Yeah, well, given the recent sort of like less or lower than expected economic data, the sort of weaker than expected economic, what's your view of equities going forward, particularly sort of the sweet spot of sort of like small and mid caps?
Yeah, so I mean, actually, we've had a very good recovery from the bottom. The economy is recovering well, obviously from a low base. That's a pretty strong backdrop. The UK have moved out to a 50-year low against the rest of the world equities, after 2016. And actually, we've seen a bit of a recovery in off the naughty step after when we got the Brexit deal, December 24th, I think it was last year. And so UK equities are a bit more in vogue. They're cheap, but it's quite a polarized market. Growth stocks are very stretched against value stocks. Growth stocks have outperformed for 13 years out of 15. So you have to be a little bit careful about what we're paying for growth stocks. It resonates slightly with the year 2000 in some ways. There's a lot of retail investors, a lot of people just investing about how they feel about the businesses, but not necessarily always marrying it against the valuation. So I've always got to be very careful about that. But generally, the economy is supportive. UK equities are cheap. Small caps, that's the kind of environment that helps. Economy good, and UK small caps were pretty neglected for a number of years. And so, as a stock picker, there's always lots of opportunities, as you're very well placed to know, Paul.
Yeah, and just to sort of, everybody's pretty aware that there's obviously risks associated with the sort of COVID still with Delta around the world. But what about the risk of sort of supply chain, continued supply chain disruption? Because it isn't a demand issue. I mean, the overall economic demand is massive. You just can't get anything. I mean, I even did an online order with Tesco's over the weekend and couldn't get any frozen peas. And I was thinking, what's going on here? But it's sort of like paint pots, electronics, cars, I mean, you name it. It's anything physical is just in short supply. Could that sort of like take some of the edge off the growth and GDP?
I can do, but I mean, I would expect it to be temporary. I mean, the problems are things with like HGV drivers, and then also getting things on boats from China, and boats have found themselves in the wrong place, containers in the wrong place. We're hearing about people who've been looking to move product onto boats because it's more green, having to put things on aeroplanes, higher value products. But I do think it will be temporary. But yeah, it is a bit of an issue. And as you say, demand is quite strong. So things like wood, building products, they have been in short supply. But we're hearing some noises of some of that easing. So they're still up a lot, but off some of the highs.
Yeah. And I had a quick run through the Crux portfolio. You've got a lovely blend of sort of like of value and growth at a reasonable price, and sort of turnaround situations, also sort of like backing some, sort of like successful previous management teams in new sort of ventures and stuff, and then quite a few sort of hidden gems. And just on that sort of like, we could sort of like run through a few of those stocks to try and find a few Emma Raducanu's, hopefully, in the for investors. But just the first one. One area that has really been sort of like on a bit of a crest of a wave recently is the IPO market. And of course, you've been quite active in that area. And let's just start actually with one you've invested in, Microlise, because obviously we just talked about supply chain disruptions, and these guys do all the tracking for trucks and lorries and stuff to help out that routing and to make it more efficient. I mean, presumably these guys would be a beneficiary of that, I would have thought.
Yeah, I mean, I think they are marginally a beneficiary. I mean, JCB's a client and volumes there offtake is really strong. But I mean, it's got 53% of the UK market for fleets over 250 vehicles. So strong market share. It's a software as a service, so it's very high gross margin. It's been, built from reinvested capital. It's not a private equity workout or anything like that. And, management have been with it a long period of time. A really good alignment of management with us. It blew about £1.35. They've done very well, so we think it's brilliant business to own for the long term. If you're buying today, you probably need some good news to come through, which I think there will be. Continuing growth. I think they can improve their margins a bit as a public company. They've invested 5 or 6 million a year on new products, so actually some of those new product modules they had for sort of routing vehicles, saving petrol, those kind of things, you know, they weren't able to sell them last year, so you will get extra revenues to come through. And it's sort of a little microcosm in a way of where the UK is. I mean, it's a cloud computing, it's probably about 5 to 6 times revenues. It's pretty expensive against the UK market, but your US comps are up at 15 or 16 times. So I think it's a buy it, own it, and hold it.
Yeah,
it feels really good.
Presumably with 53% of the market, that brings up pretty big economies of scale, doesn't it, and barriers to entry for anybody else, because your marginal cost of bringing a new customer on is a lot cheaper than anybody else, and therefore you're in their best sort of a position to be able to win new business as it comes on.
Yeah, I mean, that's the thing with cloud computing is you have your cost of developing the product, and you know, you can't have the product half ready, really. You have to get it up and running, fit for client purposes. And then actually you've got a huge drop through margin, which is sort of, you know, if you've got the revenue growth, hopefully 15 to 20%, and you're dropping through 60, 70, 80% of that, you're going to see EBITDA margins go up very strongly, which of course is the beauty of the sort of SaaS type models.
Yeah, no, it looks a lovely little business. And another one which has sort of come to market, which is sort of like, you know, great management sort of team and stuff, is Revolution Beauty. That I think is run by the founder and CEO, Adam Minto, and they do sort of like high quality, affordable cosmetics and other beauty products. And they've just sort of like gone from a standing start in 2014 of 0 to nearly 200 million turnover. Can you just take us through this investment thesis?
Yeah, so the gross margin's up at 52%, well, about 50%, I think they are. They're obviously into some of the new digital models, influencers, but also physical retail as well. But a 50% gross margin, I think we're moving out to about 200 million of turnover next year.
Yeah, a
really strong growth. And you know, I guess on today's numbers, it's a bit expensive, but you're buying into the revenue growth and that 50% gross margin, and gradually increasing EBITDA margins, increasing revenues, increasing profits. And I think the year sort of 23, 24, I think it's February year end, you know, we've kind of got 15, 20% growth penciled in there from the analysts, but that looks too low. If they hit the numbers next February, it's difficult to see how it's not going to be a lot bigger than that. You've got things like Target rolling out in the whole of the US. You just go through the number of outlets that they're going to be supplying. You've also got, I think, hair care and skincare added to makeup products. You know, the growth should be stronger than that, and if that happens, then that should be very good for returns.
Yeah, they're really sort of like a challenger brand, aren't they, to the likes of Revlon and all the other sort of like the Max Factor and people like that. And I guess the other thing which is sort of like helping them is that, you know, the long-term demise of department stores has taken away that shop window for a lot of their competitors, and therefore it's become more important, particularly for the younger generation, to actually buy and sort of experiment with cosmetics online. So you win your customer, and then hopefully keep with that particular consumer throughout their life.
Yeah, I mean, and I think the price proposition is that you don't get a better product for paying, you know, 3 or 4 times the price. Major brands. It might feel better, and that might be the issue, but certainly, you know, it's been growing really well. And for a price-conscious consumer, they get a really good product for a third of the price. So, you know,
when I spoke
to retailer as well, I think.
Yeah, when I spoke to Adam, I think he's given himself a target of trying to reach £1 billion in turnover over the next 5 years. Which, if you run the numbers on a normal sort of standard margin, you get over a share price of £12 compared to £1.60 at the moment. So
no, I agree, but I mean, on the face, absolutely, the growth seems to be there, and you know, if he delivers that, then you know, £12 could be any number.
Yeah, and then another one which is IPO'd is Dianomi. Now, I think they do sort of like native sort of like digital advertising in sort of the financial community. They put out some numbers actually this morning, which were pretty good, and you know, their outlook and stuff like that. Do you want to take us through that one, because it sounds like they're not going to be disrupted at all by the banning of cookie tracking through the likes of Google. In fact, they could be a beneficiary.
Yeah, I mean, this morning, you know, the numbers are good. They're a beat. Again, it's a bit like a SaaS story in a way. They've built the platform there to deliver these sort of context relative adverts. So if you're looking at a financial article in PFT or increasingly CNN for Dianomi, they will be able to serve adverts from financial service providers that would be relevant to the context that you're seeing it in. So they target the consumer according to what they're reading, rather than having built up the profile from cookies, which of course are things that are likely to be banned. So, and again, it's to build the platform, and then it's drop through margins. I think the gross margins there are about 35%, which is typical for these kind of digital advertising companies. But there shouldn't be a lot of extra costs for building the platform. And they're also moving into sort of lifestyle categories as well as the financial product space.
Yeah, well, the shares have done well, like Microlise. I think they were listed in May at £2.73, and they're currently £3.80 as of this morning. So you've hit the ball out of the park on a few of your IPOs already.
Have been good. Yeah, I mean, actually, it's been interesting. There have been a lot of new issues, and I think there's a lot lined up. So you might expect there might to be indigestion in a few of these things soon, because the investors like ourselves out there, we only have so much money coming in from takeovers and dividends, and then hopefully more subscriptions into funds that are doing quite well. But then there's a lot of these issues and rights issues for companies that are needing refinancings and things. It sucks the cash out of the market, and that can, equities at the end are always about supply and demand.
Yeah.
So a lot of these new issues, so it's great that they have done well. And I think you might start to have a sort of 18 months to 36 months time horizon for these stocks, because when they do that well, there's obviously less upside in them in the short term. But Dianomi good figures today and a beat, and we're seeing that elsewhere with the following economy as well.
Yeah, another one which is sort of like a buy and build to the SaaS business. In fact, I think it's a different one. It's basically it's Glantus, which does accounts payable and big data sort of management and stuff like that. It's a bit of a buy and build, and I think the management team have sort of said that it's looking for M&A to get sort of the scale. Do you want to take us through that one? Because there is actually quite a lot of M&A going on, because I saw one of its peers, Proactis, get taken out by private equity a couple of months back, Pollen Street Capital.
Yeah, I mean, it's essentially Glantus is a vehicle, as you say, in accounts payable. UK software, UK and US acquisition recently in accounts payable, sometimes using artificial intelligence. Effectively, and it's a vehicle chap called Maurice Healy, who's good with a business called Calyx, and I think LTD before. And so he's done it before. He's got his own money in it. Effectively, he's buying businesses at 2 to 2.5 times sales, putting some more growth into it, taking some cost out. And when you get to sort of 20-25 million run rate, you're right to point out there are these takeovers, and for US businesses at that kind of scale, they're sort of 4 to 5 times revenues potentially. So he did it floated at £1. They're a bit below that, but they've done a very good deal that's been 25% accretive. So you'd expect them to be further on than £1 really, but as discussed, not everything is making the progress we might have thought. But the business is doing well, and so he will add other businesses, I think, and at some point, if you were to sell it for 4 to 5 times sales, which is an aspiration, might be next year, it might be in 3 years' time, you're kind of more like £1.80 than where we are today.
Yeah,
about half that, I think.
And when you do these IPO, we invest in them sort of like when they come onto the market in the prime. Do you sort of also build in the possibility of a secondary, place to do these acquisitions for the buy and build? Yeah,
so I mean, how much of the fund we put into it might reflect how much more they might raise in the future. We've been lucky enough that we've had a bit more money coming in, so we're very well placed to put more money in. It went down a bit actually, so I bought some more actually, particularly when they did the deal where the earnings went up 25%.
Yeah, no, I was just saying, it does look cheap compared to its competitor. Another company that was IPO, which has got big aspirations, called Big Technologies, and they own sort of I think it's prisoner sort of tracking and sort of like correction. They put the software for prisoners to be tracked at home and stuff like that. He says Big Technologies under their Buddy brand, and the shares have done tremendous, haven't they? I think so.
It floated at £2. It was very popular with investors, so not everybody got the holding they wanted to do. It wasn't about 30 times earnings, and that's a year forward. And as you say, they've gone up. What are they this morning? They're 370, so they're up a lot. They're probably around the 50 times mark. But actually, I was sort of thinking, well, I'll be saying that they need some good news. But we've had some this morning. They are pre-selected for a contract in New Zealand. So,
oh wow.
Who knows how much that could bring, but it's probably 5 to 10 million of revenue and a huge amount of it dropping through. So their proposition in tracking either prisoners basically, or it was actually invented for
offenders,
tracking children, sometimes people that are in mental health institutions, is that their product is better than other technologies that track people. So there's less intervention needed from the central authorities. It actually means that the prisoners, etc., have a better experience, and more such people are able to be back out in the community. And for that reason, they are replacing people in contracts like the New Zealand deal today. But I suppose the one issue there is it's a 3 to 5 year contracts, which is great when you've got them, to displace other inferior technologies. Obviously, in the likes of the US, it's going to take you might get 1 or 2 a year. But so I think part and parcel of the float was potentially they can do acquisitions, and I think those could be highly incremental. There is capital there raised from the float to do that, and it's quite possible they could buy things that maybe are struggling against their competition on much reduced multiples compared to their own, and for them to be very, very enhancing relative to here. So we continue to hold that, and the chief exec, Sarah Murray, who built Confused.com, is on quite a lot of government panels about technology. Is very, very impressive. So again, it's a sort of want to buy. From time to time, it will look a bit expensive in the short term, but it feels like one of the few that can really grab the attention.
Yeah, well, it should be a super durable stock given the contracts, and it's supplying basically the government. So you're pretty much guaranteed you're going to get paid. And if we can declog some of the prisons, it's got to be good, I guess. And if you've got a product that is reducing cost for those particular clients and reducing the amount of things like false alerts and stuff like that, it's a winning formula, I guess, isn't it?
It seems to have been today. Yeah. They're still in the phase of winning the contracts. We don't see any sight of anything, better than their solution. So, and then there's still the chance that actually they may go back to the original usage case, which was for sort of older people in the home, maybe people with dementia that occasionally leave the house and you don't know where they are, or just aged parents where you just want to check up that
they're okay. And then the last one, sort of like on the IPO front, is Arecor Therapeutics, which I think sort of like has got technology that helps sort of like change the sort of formulation and make feature improvements of existing drugs, sort of like concentrated into different things like diabetes and stuff like that. And I know it's still early days, but that's really sort of like getting a lot of coverage, I guess, because it's to take some of the resource out of the hospital, such that that you can do it at a home, I guess, as in like things like help diabetes patients so they don't end up in hospital.
Yeah, I think that's right. I mean, it used to be the Unilever sort of technology division for doing these formulations. Cut a long story short, they've got a better chemistry set, or they've got a different chemistry set, and it means that you might have a product where you've got to put your distilled water in a hospital environment. You might be able to make it sort of shelf ready to use for the nurse. You might have products that might have to be stored in something like a fridge that actually no longer have to be because of the chemical properties. And you are modifying existing properties, and that's really important, because it means rather than a 10-year approval cycle, it's kind of a 2 to 3 year cycle. I was very impressed with the commercial people there. I saw it a couple of times before it floated. We had 3 meetings with them, but from 6 to 9 months out. And you mentioned diabetes. Well, key players there are Novo Nordisk and Eli Lilly. And the challenges here is that you can automate potentially treatment of diabetes with insulin pumps. So you would have a meter reading and you would be able to apply the drug. To do that, you need ultra fast insulin, and that's one of the things they're trying to develop. Otherwise, the control loop is not crisp enough. And the other thing that they're also trying to do for people that need big doses of these, I think type 2 diabetics, you need too much drug to put it in a pump. Well, their ultra concentrated product potentially can do that. So this is more of a 2 to 3 year story. Sort of revenues that there could be interesting partnerships probably next year. We'll get some data, and we've seen some more collaborations. They're building up those list of collaborations. Sort of pretty much, it looks like they'll do 2, 3, 4 a year. And it's a bit like a business called Maxcyte I have, but they have these collaborations that's slightly longer term, but ultimately been quite good.
Yeah, if you've got existing drug and you're just trying to get some new features, then the safety profile should be absolutely fine. And if you can do things like extend the duration of that particular drug and it's effectively, then I guess the hospital has got to doesn't inject it into patients as often, or tablets haven't got to be taken as often. So there's lots and lots of things you can do, isn't there, with that platform, I think.
Yeah, it's just recognised that with the FDA and the regulatory authorities that you only have to do certain trials which are a lot shorter, and that means less money has to go into it and it takes less time. We don't tend to invest in we're going to find the newest cure for cancer in a small company. It just takes too long, and you have to keep putting more and more money into it, progressively higher checks. You don't know the market environment at the point where you have to do that.
Well, one company that has really sort of like is advanced ADVT, which I think is sort of like the new sort of buy and build vehicle for Vin Murrier, and she's got a really sort of like formidable track record. I mean, she's done it before in terms of buying software businesses, IT businesses, and putting them all together, integrating, and then selling them on and making a lot of money for investors. But how do you see that sort of playing out? Because there's obviously always a danger when you in buy and build and SPACs essentially, that you effectively they have to overpay when they buy. But what's your sort of view with this one?
So I mean, she has raised the money, put 17 million pounds of own money at a pound. They're above that at 117. People in this case are obviously paying up because she's done very well with 3 quoted businesses before. Other similar things she's been invested in. The Summerway Capital, I think it was, went to about 150% premium. I don't know where it is today, but clearly we're waiting for her to do a deal. You mentioned overpaying. I think it's more likely that it would take longer than her overpaying. I think just in conversations with her, she would be very forceful not to overpay. And historically has bought the right things, got exclusive deals, and improved them. So I think my understanding is she's trying to build something that she can buy it and then add things to it that will be, each deal would then be incremental. So it's early doors in a way, but because we've done so well out of it, we're very happy to back it early, and I think it will ultimately be very rewarding. I mean, one of the goes on in the stock market is that when things are early, obviously you don't have many people that support things, and a lot of people deploying huge amounts of capital in their strategies and billions. They're not going to put 5 or 10 million pounds into a 100 million pound company. But as you do deals and you get a bit more proof of a track record, those people sort of come into it, and they will put 10 and 20 million pounds into things as there's a bit more delivery and a bit more evidence. And sometimes if you're comfortable with people that made you money, and particularly in a startup like Crux is, we can back people early, and that can be some of the easiest money to make in a way.
Yeah, you basically choose the right horses to back, and that was what you said. Ones who've got just demonstrable track records, the sort of the key winners of the St Ledger and the Oaks and all these other big sort of like blue ribbon. They've done it before, basically. They know what they're going to do.
I think so. I mean, another one that's a bit like that. I mean, Kistos.
Yes.
I don't do a lot in oil and gas and mining, but there's a business called Rock Rose, which I think went up 13 or 14 times. So Andrew Austin behind that. He made a lot of money himself from that and has put that into this vehicle. He has he makes slightly more money than the other shareholders, but money was raised at a pound. He's bought a very interesting gas asset in the Netherlands, which they got incredibly low carbon footprint, and they drilled and found some more gas there. So what's perhaps significant is when he bought it, the gas price is about 15. I think it's about 15 in Rotterdam, and it's currently about 55 due to some supply.
Wow.
Now I think, we're not saying it's going to stay at 55, but even if you stay there for a few months, the cash coming in is huge. Somebody was rehearsing the argument that it would be doing about 200 million euros of next year at spot rate. Well, that might tell you that spot rate's too high, but that would be very good for us. And of course, there is always the optionality that he will buy other things, as he did with Rockrose. So that's been very good. Up well over 100%.
Yeah, I mean, it still looks very cheap even at today's pricing. I mean, I was running the numbers, and even on sort of like rather than 200 million euro turnover, he did. I mean, I've got 86, which is like a blended for next year, and you still get less than 13 times PE, which is just like super cheap.
I think so. I mean, I think we'll have an update on the numbers. So I think some of those kind of consensus sort of profits for next year are going to go up quite significantly on the back of this gas, because I think a lot of people are using about 30 for the gas rather than 55, which is correct, because you want a long-term number that is sustainable, but they will make some super profits.
It's really interesting on the gas market, because I mean, essentially globally wise, there's this huge shift from dirty coal into cleaner carbon fuels like gas. So the LNG price everywhere has gone massive. But likewise, because there's less investment in oil sort of exploration, then because you get the gas at a lot of the gas comes off at the same time. You don't get pure gas fields. Then the supply for natural gas is actually getting tighter as well. So you've got this huge, bigger demand, and you've obviously got sort of like tighter supply. So it's a really strange dynamic. It could be a very strong market for the next 2 or 3 years.
I think it can, and the forward curve. We were talking about the spot market, but the forward curve out into next year is still positive. Quite a lot of the specifics of Northern Europe are down to some fairly binary decisions around pipelines coming out of Russia through the Ukraine and these kind of things. So those could be overturned quickly or not. It's difficult to predict those things. So that's why there would be some caution about staying up at such high levels. But the prices at the minute are way above. The shares are very cheap if we stay at these prices.
Yeah. Well, I mean, just for investors, I would definitely say, have a good look at this. Because I don't normally look at sort of oil and gas sort of stuff. But if you just use a data point of the 2 weeks ago, when you had the UK government getting its wrists firmly slapped by the media for having to turn on a coal-fired power plant instead of a gas one because the gas was too expensive, and that was a major political sort of embarrassment for the UK government, then you can guarantee that next time they do it, unless there's a massive price increase for doing that, they're going to substitute it with gas, because they just get too much political flack for having to turn on coal essentially.
Yeah, and gas seems the acceptable face of hydrocarbons at the minute, and Kistos are talking about producing the gas at equivalent of 60 grams a barrel, which is that packet of crisps, whereas normally it's about 20 kilos, which is a suitcase of the stuff. So I think that is acceptable, and I think they're committed to doing more similar sort of things around low carbon footprint.
Yeah. Another one was slightly different, which is obviously back in a really successful management team, is Likewise, which I think does sort of like carpet distribution throughout the UK, and I'm sure that business is doing really well, because we've just as an anecdotal evidence, my wife has just ordered some carpets, and you try and get some Axminster or anything like that around the country at the moment, even sort of Cardine floors and stuff. So that's in short supply, but the demand is just enormous. And I think it's headed up by a guy called Tony Brewer, isn't it, or something?
It is, and he, 20, 25 years ago, was with Headlam, and there's good experience, just total knowledge of immersed in that sort of floor distribution market. And, actually, you're right to point out that it is strong at the minute, but I think it's more about what he's doing over 2 to 3 years there. And, he sort of put his own money in it, sort of friends and family. We put some money in it. 10p about 2.5 years ago, and they were on the international stock exchange, of course, it's Guernsey, but as they moved to AIM and London in last month, we saw a lot more money going in at sort of 25p level, but the business has moved on, so it does justify that kind of level. And even following that 25p raise, they're up at the sort of, I think, mid-30s. But
yeah, they are. Yeah, 38.
I mean, you are seeing that incredible strength in this kind of repair and maintenance, people, people working from home, spending a bit of money on their houses. We've seen a lot of that. They've not been on holiday and they're upgrading their houses.
Yeah, but the hard bit is actually getting sort of like without workmen. And another one sort of like benefiting from that whole theme is franchise brands, which I think does sort of like sort of franchise plumbing and pumps and stuff like that. And I've never even heard of this one before. So how did you come across this one? And
so Stephen Hemsley, he was the chief executive of Domino's Pizza. So Domino's Pizza in recent years has been a bit ex-growth, but starting out in about 2000, 2001, it was one of the great stocks in the UK as a franchise operation, of course. And franchise brands, believe it or not, is a franchise operation, which basically means you use other people's capital. And I think they've got a pretty good runway to getting to sort of 15% margins and 100 million of turnover, which is quite a step up from here. But Stephen's very impressive and has done very well with it. He owns about 20% of the equity. I think Nigel Ray owns a similar amount, as 40-45% owned by sort of quasi insiders. But the economy is helpful. But I mean, opening up business premises, you do need to go and clean those premises, sort the drains out, which is some of the activity they do. So yeah, it feels well positioned from a management team that have done incredibly well. And I think Domino's Pizza went up about 50-fold from the lows. Well, we're not suggesting that with this, but it certainly feels like it's on a good growth profile here.
Yeah, well, the market is just incredibly strong. I mean, that was the other thing we've been trying to get is a plumber. So it's just impossible at the moment. Now, moving on to sort of like turnarounds. How do you sort of like, there's a couple of them you've got in your portfolio. You've got Escape Hunt and Ebiquity. And Escape Hunt, as probably as investors know, sort of like do themed experiences in sort of like places and cities. Ebiquity is sort of one of the leading advisors on the advertising. They've both been sort of like up and down and stuff, but they're on the bounce. But just big picture, how do you just sort of decide whether something's a sort of like a turnaround fallen angel or a bit of a value trap? I mean, how do you distinguish between the two? Because I always find that's the toughest bit.
Yeah, it's difficult. I mean, Escape Hunt was a refinancing, so it was on a very low valuation. I think on average the money had been put into at 120, and depths of last year the money, it was refinanced at 6p, which if you added up some cash on the balance sheet and those sort of things, you're paying about £1 or £2 million for business, and it was huge option value around that. It's now a pretty strong environment for Escape Hunt because it is a rollout strategy, and getting physical premises. Obviously, a lot of people have gone out of business, so there are a lot of sites around. And for experiential leisure, a lot of developers want what they sort of do in there, and you can get really strong terms. People do the fit outs, people will give you rent-free periods. That means that sort of the new ones they open are going to get, I think, very, very strong returns. And it seems like the formula is now working. It had been a bit slow, but it's sort of gone through the pains of that. And people do want to do these experiential leisure things, and I've seen people articulate the case for how they're going to £1.50. Well, I think that might be a little bit bullish, and they need a bit more money, but the shares are not that at the minute. They're sort of sub 50p. So I'm sure they'll be updating the market fairly soon, and I think what they've said in the last few months is that the sites are doing very well when they open them.
Yeah.
And again,
is there a corporate angle to this one? Because if you're, if you basically, I don't know, if you're one of the accountants, EY, BDO, or one of the professional services, and you haven't seen your staff for sort of 18 months, they're just starting to come into the office. They're now going to do 2 days a week, but you want to sort of like get the benefits of sort of creativity and team working. These type of experiences could be ideal for sort of like doing that, presumably with sort of like, departments in businesses and stuff like that, just occasionally once every quarter or something like that, have some sort of experience away day or something that brings the team together, because going forward it's likely that lots of corporates are going to sort of reduce their physical office footprint, but still want the benefits, so they have get the cost reductions, but want the benefits of the teamwork and the creativity, and you have to think about things like that.
Yeah, so the management are talking about that, and they've had some success doing it, and it's kind of really valuable turnover as well, because kind of the times when a corporate might do that sort of office hours is exactly the downturn, which is difficult to fix, because with something like the escape room, clearly the Friday nights and the Saturdays and the Sundays and maybe in the evenings are going to be relatively easier to fill.
Yeah,
the downtime is going to be those parts of the day and the work week. So yeah, I mean, it's all upside to the economic returns, really, I think.
Yeah.
So,
and when it comes to sort of selecting companies for these sort of turnarounds, do you go and kick the tires yourself? Do you go and have a sort of like an experience on the escape hunt at all?
I have been to various escape room things. My children are quite young, so
okay,
good. I probably enjoyed it more than they did anyway, but there you go.
Did you manage to get out of the room?
Well, we did, yes. Yeah, we did.
Good man. What about Ebiquity, which I think was it sort of like was doing really, really well, and then sort of like got caught into sort of it's a traditional sort of strength, I think, is in traditional advisory of media, of the traditional media. So it's your broadcasting, your radio, your outdoors, and has been sort of pivoting quickly under new management to get into sort of the digital side. But they dropped like Escape on their shares dropped to ridiculously low levels. But I think it was roughly around about 20p at one sort of stage.
Yeah, it's a cyclical business, and I mean, it's the sort of threefold factor here. You've got a change in management, you've got the economic recovery, and then you've got potential to move it from a kind of service-based to a digital, more software-based offering. So they help 70, I think, of the world's top 100 advertisers, advertising agencies, help audit that money that's spent. You always say that 50% of advertising is wasted, but you don't know which. Well, they're trying to help that.
Yeah. But also with the internet, isn't it, as well? It's sort of like making sure that your ads don't get put onto sort of like offending websites and stuff like that.
Yeah, there's all sorts of issues about how you spend it, brand reputation, these sort of things, and clearly they're well versed in that. New management, the experience over the past was just sort of not quite always delivering the promise, but the new management coming in are very much under promise and over deliver. I think we hear from them fairly soon, but the advertising market's been strong. The cyclical recovery would hopefully take you up towards 90p a pound, which would be good. Yeah. But the other interesting thing, and there's quite a good thing on their website, is they had an investor day Q3, Q4 last year of how they'd use sort of software offering. Obviously, you can automate some of the data from digital advertising to give feedback to the brands that they work with. And they brought in a little German business run by a tech entrepreneur, and he was doing very well. But of course, he was a very small business. Now you're putting into Ebiquity, where they talk to these 70 of the world's top 100. They're building out modules that tell you about brand safety and who exactly is using your advertising in what way, and that could make it more automated so that it's more scalable. And Pamela Gordon who talk on it really, but they sort of model a case where you go to £1.50, £2.50 over a couple of years if that digital strategy works. So next time the company talks, we'll be looking at that. Shares are sort of 55 to 60p. Management were buying the shares around about the 40p, I believe, and they're relatively new, as I say. So that one feels really promising. Actually, it's sort of a recovery stock that has the ability to go from sort of slightly old economy to sort of new and digital. It could be really good.
Yeah, I also understand that one of their biggest competitors, Anderson Consulting, who used to do what they used to do, dropped out in the market about 12 months ago, and they must be getting a following wound from that, because there aren't that many businesses of this sort of scale and sort of reputation that be able to pick up that sort of like those looser accounts, because they've got to go somewhere. And if you're a brand, you want somebody you can trust who've done it before to be able to give you the best advice and the best auditing, I guess.
Yeah, they have won accounts from Anderson's, and I mean, there's also this thing that quite often they do a 3-year audit with the brands, so they do a third of them each year. Well, last year they had a year off because of COVID, so there's some point there's a return to normal levels of activity, but there's also probably a catch-up trade as well, and the Anderson's bit as well. So we're very hopeful of that.
Yeah, no, again, I mean, I think it's still very cheap, and I know the management team. I've actually spoken to Nick Walters, the CEO. I really rate him, so he's definitely. In fact, that seems to be a pretty sort of strong trait within the Crux portfolio. You back sort of the guys who really know what they're doing and really committed.
Well, we do. I mean, I left. I worked at Legal & General for 15 years, and I've been M&G. These are the places. Crux is a boutique. We sort of back ourselves. We put our own money in the funds, and if you follow that through, if you invest with people who've done it before, they're putting their own money into businesses. It feels like the right thing to do. Really, you sort of feels like you're going to get better outcomes.
Yeah, yeah. Well, I say investors might want to have a look at your fund because your record's pretty good as well. So it goes all the way through the bloodstream. Now, just on sort of unbundling plays, asset plays, etc. Trufin has obviously got a lot of investor excitement of late, but that seems to be sort of like again a whole bunch of different types of businesses, software and invoice factoring and gaming. Do you want to take us through this one, because it's got a lot of attention and it's got a bit of a blue ribbon contract, or should we say doing a pilot with Lloyd's as well, I think.
Yeah, so you're right, they've got 4 divisions. I mean, all of them loosely fit into sort of specialist lending sort of platforms on sort of fintech type setups. We kind of bought it when you could add up all the capital in it and the cash on the balance sheet, and that was a bit more than the price. I think we paid about 30p. What's interesting though is they've been developing the 4 subsidiaries for some time now, and they're all at quite interesting stages. So Sotago has this trial with Lloyd's, and I think we're very hopeful for that. But these things, if
it works, Lloyd's is going to buy it, buy Sotago. I mean, there's no way it's going to not, I guess. But hey, that's probably just maybe putting one and one together. But it seems that if I was Lloyd's, you'd want that inside you.
Well, it's probably cheaper for a bank like Lloyd's to buy it than to try and do it themselves, and of course it would take less time, but time will tell. I mean, it's in trial at the minute, but that's been going well as I understand it. They've got an interesting little games company, I think, called PlayStack, that if you value that a couple of times revenues, gets you quite a large part of the market value. And they've got a trial there for again for sort of advertising, where you incentivize people with kind of vouchers when they achieve certain levels in games. So that's a platform which may or may not work, but it's sort of in some ways it feels a bit like myriad advertising and things that valued at quite high values. So that's again is optionality. You've got Virtus, which helps fund wealth managers buying out their businesses. A business called Oxygen, which could be really good, because it takes quite a long time to build these businesses to a critical mass, and then they're at a point where they're about break even, but you could see that go very nicely profitable on a brilliant growth profile. So it feels like sort of 4 companies that people would get incredibly excited about if they were new floats or things. I think management would be disappointed if the sum of the parts isn't comfortably north of £1 at some point. But there's a bit of an overhang in the stock there. A company called Hourglass, who owned a very large part of it, now at 20%, having been 60%. They are perceived to be an overhang. Who knows whether they would want to sell the shares or not? But there are some fund structures they have that apparently close towards the end of this year. That may or may not be an opportunity that people are anticipating.
And when you have a sort of like something which seemingly is an unbundling opportunity, does sort of Crux get involved in that whole sort of like process of sort of trying to help that through to maximise shareholder value, or is it very much sort of like leaves it more towards the sort of management team?
Historically, I've done quite a lot of that, particularly when I was at Legal & General. I mean, your ability to influence management is closely correlated to how much the business you own. So, we started off with 10 million, and nearly 3 years ago, about 120 million now and growing. So increasingly we'll do that. I'd like to do it, and we're generally pretty helpful. We're not trouble causers. No, but you know, some people go very high profile and all over the Sunday Times, but generally we'll chat to the chairman if there's a problem with the board or something, or the strategy, and we'll try and influence and shape it. And, you know, we recognise that, you know, we might only be 5 or 10% of the business. There's always other 85, 90% of people will maybe have different opinions. But if you do that and you're not comfortable with it, you always have the option of selling, of course.
Yeah, which is all. Yeah, maybe may or may not be possible at certain prices, but yeah, if it's an obvious unbundling, which it does seem to be at some point. Another one which has came out, which actually just shows you the craziness of the market, is AB Foods. It came out, it upgraded its forecast, it increased its sort of cash expectations for the year end, and the shares went down this morning, which was just like incredible.
I was surprised. I thought I knew that this would be one I might want to talk about, and
they own Primark, don't they?
There's something gone wrong, you know. But Primark, I mean, all you ever see when there was Unlock was people queuing outside Primark, and as I understand it, the retail format in the US, they've got it now to a level where they can move that on, doing quite well in Eastern Europe as well. So it's taking market share as well, even though it's predominantly a physical retailer, because quite a lot of the competition have gone out of work. And the footprint they have is capable of doing $1 billion of operating profit. Last year it did 350 million. So, you know, it's a huge recovery play in terms of Unlock, I guess. But what's perhaps overlooked slightly is the sort of Twinings and the Ovaltine.
Yeah.
The other brands that are in there, they're very resilient and done in the sugar business, and they got 1.8 billion of cash. So you're really not paying a lot for Primark, and perhaps the other businesses at proper valuations are probably 17, 18 quid. And people were so excited about the Primark opportunity when they first set off in the US. So for them to be trading sort of 6.5, 6 times EBITDA, you know, it might be a slow burn. It might take time to come out, but it feels like a, you know, substantial value behind that. It feels like it could easily be 30 quid. It might take you 3 years to get there, but as you're saying, it's good to have a mix of nice growth stocks and some of these value ones where they're just loaded up with value.
And what would be the trigger for that? I mean, as in like to unbundling, because they own, is it the Western family still own around about 53% of that? I mean,
they do. Well, I mean, interestingly enough, there could be several triggers. I think they are actually trying to sell Selfridges at the minute, for which they might get 4 billion quid. But I don't know whether they all operate as one unit at the minute. You know, sometimes when you go second, third generations, then people have their different opinions about what they do with the money, and the state will be owned in different places. I think Unilever's tea business is for sale. They may have an interest in buying it. We might see a metric there that says that you know, Twinings is very valuable. But I think that perhaps the biggest one around the sentiment of the stock and Primark is digital strategy. So they've said that they're going to do better with a digital strategy, click and collect, these kind of things. And you know, I suppose if Primark is driving how people perceive the stock, even though it's not a lot in the price for it, and it's predominantly a physical retailer and everybody loves the ASOS and Boohoo's, then if they can improve the digital performance and people, you know, pick up the growth a bit there, make some of the stock lines available from the big stores into the smaller stores, then you know, that should improve the perception, I would have thought.
And what's the logic of not having a sort of like a, you know, basically a online delivery shopping channel for Primark? I mean, hard discounters elsewhere, your Aldi's and your Lidl and this sort of stuff, have suffered because they haven't had it, and therefore Tesco's and Sainsbury's and all these guys have taken market share. The same thing, even though they've got a terrific product that everybody wants to buy, hence the queues outside, the younger demographic just want the stuff through the post, you know, and are happy to sort of like return it. And I know it's a big cost, but what's the sort of the logic of not having an online channel?
I think it's to do with the average, you know, the price of the products is low, average basket size, and whether you can afford to do distribution and having people return the products. I think historically they couldn't. You know, if you're selling stuff for a fiver and it costs you 3 quid to ship it, and it beggars up the
I suppose so.
The economics of it. But there may well be things you can do by having it delivered to the local Spar or whatever, you know, and you know, click and collect, or these, you know, those kind of things.
They look creatively, yeah. Another one which has come out with blockbuster numbers this morning was MP Evans, which I think does sort of like it does palm oil sort of farming and selling and stuff out in Indonesia, but sort of like.
Yeah, I mean, it's an old-fashioned British business that's been building these growing palm oil plantations, and there's just a thing going on where it takes a certain length of time. You have to get the seedlings and they have to grow, and then they start delivering palm oil. Well, just the maturity of the trees they've got now, and they've got a lot of them, are at the point where the yields are going up. They've had a little bit of a positive around taxation and duty in Indonesia, which might sound a bit technical, but basically means they're probably making 25-30% more revenue off each ton at given prices. And they're just at that point where they've done a lot of the investment, the yields are going up, price has been really strong around the kind of reflation. And you've seen bumper profits today, so I think they've done about 42p of earnings, could be £1. Yeah. Asset value, if you go on a website, I think there's quite a good valuation done by a third party. I think the asset value is about 11 quid. They're shy of £8, but there's a stake. Somebody's got a stake of 20% there that has made bids for it before. So it feels a bit like an each way bet, really. And all the difficulty of growing all those seedlings and waiting for them, and the patience has been done, and you're into the collect the cash and not too much capital investment, I think, over the next few years now.
And why is the palm oil price gone up globally? Is it simply because it's sustainable palm oil, and therefore it's a sort of like people are substituting that sustainable stuff from stuff that isn't sustainable, or is it also a substitution from other vegetable oils into palm oil because it's better for you, or health benefit? I don't know.
So I mean, their product is more sustainable than others, and they've got strong credentials around that. But generally, I mean, all commodities have been quite strong around printing money and
soft commodities.
Yeah. And sometimes the products are interchangeable with other oils. Obviously not mineral oil, but there is some element of substitutability there. Increasing environmental standards, people may be building on some of the land in Malaysia and Indonesia. It's quite difficult to build these things, and actually, if demand goes up, we've got gently rising populations throughout the world. Developed economies, people are going to consume products that have more palm oil in them, sort of biscuits and things, and rising demographics and affluence gradually do lead to increasing demand, and supply is quite difficult to bring on.
I suppose during the pandemic, everybody was having their digestives, haven't they, and hot knobs at home because they haven't been able to get them out at cafes.
And I think it's people globally. I mean, I think it's demand in emerging markets, and your people with rising incomes in Southeast Asia and these kind of places.
Yeah, and then one sort of other interesting opportunities is a really, really cheap mining company, Atalaya Mining, which I think sort of mines for copper in Spain. So there's less geopolitical risk. But when I was just doing the numbers just this morning, I'm putting in the latest one, and I mean, I saw that the actual shares are currently trading on about, less than 5 times PE. I mean, if you believe the numbers, I mean, it's this frighteningly cheap. So you'll take us through that one, why it's so cheap.
Yeah, I think there has been an overhang there that's just recently been cleared, so we've seen the shares move up a bit. I mean, the copper price is at a high, so a lot of the multiples you're looking at are probably on a copper price that is more recent. But the case for copper is pretty strong. Supply is difficult to bring on there. There's no big mines to come on. Bit of disruption around Chile and Peru, where sort of some of the politicians want to nationalize everything, which is not great. So supply, are we going to get many new big mines? Don't think so. Demand, a lot more copper in electric vehicles and turbines. So the long-term demand outlook looks good. People like BHP are saying, it could be a bit more supply come on, but the mining industry and the analysts seem to think that, as they have done for the last 15 years, copper just looks really good in supply demand, which is why we're up at sort of $8,500 to $9,000. At these sort of prices, they're doing about 50 million euros a quarter in EBITDA. That's what, 200 million a year.
Yeah.
And
That'd put it on 2.5 times EBITDA.
Yes.
I mean, that is just nuts.
If anything, it might even be less than that. I mean, and there's very limited debt. The management team, I mean, I saw them 3 or 4 years ago, and they were building this mine in Spain until development risk. That's fine. We'll wait and see. And I've revisited it recently, and they built it. They've done it quicker and under cost, which never happens with mines. And I think the experience of those guys is that they built mines in the Congo and things. So building it in the middle of Spain is not so difficult. And there is scope to build the footprint, the tonnage out 3 to 4 fold. They've got quite a few interesting things in there. So I mean, it could be really, really good. I mean, if the copper price was to go up, I mean, you could make a great deal of money. Just that one caution of the spot price versus where people are on the long-term copper. But their cost, I think, in recent quarters, has been about $250 a pound.
Yeah.
I think I see that coming down to $225. Well, we're up above 4 at the minute. So there's, obviously every 10% you drop off copper, it's going to take 20% of profits. But they're very, very cheap at these levels.
Yeah.
And copper price may go up. Who knows?
And I mean, they must be in the crosshairs of some of the big boys, because if they want to increase their copper exposure and perhaps get rid of some of their coal and replace it with sort of other, put it with industrial metals, then I don't think you can get a cheaper play than this one.
I don't think you can, but I mean, I think the bigger miners need companies of such a size and projects of such a size that they might not consider this one. But I think what is really interesting is there's talk around them moving their listing and their domicile out of Cyprus, I think they are, into London and onto the main list in the UK, which that's talked about in the statement. That makes the stock very much more ownable for people, and things like that can make a real difference.
Yeah, absolutely. I mean, another one was not quite as big, but probably is around about is Inspecs, which I think does sort of like eyewear and lenses and frames and stuff like that for glasses, and they sell their own brands but also distribute others and stuff. Do you want to take us through that one? Because obviously it's is this another one with a disrupting, a challenger brand disrupting sort of your Oakleys and Ray-Ban and your Gucci's and Armani's and stuff?
So I mean, it floated February of last year. Essentially it was a British business then that had some factories in China and Vietnam. It had some niche brands. That the company made John Lennon's sort of gold rimmed, round framed, but it was making mainly for chains, and I think a 42% gross margin, doing 20% EBITDA margins. They bought a little business called Norville that makes the lenses to go with the frames for eyewear, and just zooming out a minute, you're seeing 6 to 8% growth in that market as a whole. They're growing a lot stronger than that. Gross margins for glasses, guess what? They're 50% plus if you've ever bought any glasses, which obviously I have. It's going to cost you a few quid, but you pay it. So it's a good market that way. So steady growth. So they bought a business called Norville, which makes the lenses. I think they paid £2.5 million for it. It had struggled under COVID, but a leading supplier into the UK opticians. So they're putting that into new premises. They bought another business called Eschenbach, which is the same size as the traditional UK one, and that it was doing about 60% plus gross margins, but 10% at the EBITDA line. So the combination of the German and American business with the traditional UK one, you can then make some of the frames in China and Vietnam. It takes a little bit of time, so that's a 2-year story. The Norville business, I think we could see go from 10 million of revenues up towards 30 over 2-3 years. Potentially that's a 5 to 10 million delta. And the shares at about 30 times earnings are not cheap on the forecasts that are out there, but you can see how the forecasts are 50 to 70% too low on sort of 2 to 3 years. So put that in context, I think they're forecasted to do $25 million of EBITDA for this next period. At the interims, they've done 17 or 18. So, and that's not because they think they're going to do 7 or 8. It's just caution around COVID. They're playing very cautious because, opticians can get disrupted by things like COVID. But if there's no disruption, you'd expect them to be, well ahead. So they may really only be on sort of 20-25 times. So overall, it's a business that's probably going to grow its top line 12 to 15% revenues organically. It's 50% gross margin. You should see EBITDA margins going up, and then there will be other acquisitions. So they've quite openly stated that they do that. And I suppose the really big company in Europe that people look to is Luxottica, which is
Luxottica,
I mean, that's very highly valued, but then that sort of is the industry and the demographics and, you know, really strong market position. But this one feels like a really good growth story that it's just the sort of stuff that people, you know, love, with the long-term growth and the high gross margins. And, you know, as it gets a bit bigger than the 300 or 400 million, I would firmly expect it potentially to be a bit like a Decra or a Genus, which, you know, one of these defensive growth stocks that just re-rates. That's a bit of a bold call, but you can tell.
If you get those type, exactly, if you get those type of returns. Now, just finally, then, sort of like looking at sort of like rising stars or new ones. You've got two in the portfolio, Maxcyte and Maestrano. Now, Maxcyte's just been knocking the ball out of the park for about the last 2 or 3 years. In fact, somebody recommended it to me sort of 3 years ago, and I should have put some money in because they're just fabulous sort of shares. And then Maestrano is on that sort of like early stages. It raised some money at around about, I can't remember, sort of like, was it 14p? And the shares are probably about a bit flat on it at the moment. So can you just take us through those and what sort of like what you're looking for? Because if Maestrano can be anything like Maxcyte, then people should be putting their slider all over it.
They should certainly be looking at it. I mean, there's sort of proposition here is sort of technology crossover. So there's some really highly valued companies in the US around things like gene therapy in the case of Maxcyte, and then artificial intelligence and driverless cars that come onto Maestrano in a minute. And, you know, people will pay any price for these things. If you then come across the Atlantic, you know, large cap equities are cheaper anyway. If you go down to micro cap, there's not a great tradition of investing in some of these earlier businesses, and my key to this is often sort of Goldilocks of growth. If you're too early, then you need all of these. You have to put lots and lots of money into it. They often fail. If you buy them too late, then you're paying 50 times for them, and everybody knows about them. And Maxcyte, I was just they had a sort of enabling technology with some of the very interesting US companies that are out there.
Is it
electric?
Yeah, well, I can't remember what it's called. Yeah.
So, you know, when the human genome was sequenced, people knew that there might be new drug targets and things, and guess what? Those have come through. So immunotherapy, so-called CAR T drugs for modifying immune system.
Yeah.
But then you have to modify the cells and put them into the body. Well, their product helps you do that. So sort of picks and shovels. But because it's enabling, they also get royalties and milestones, and so they've got those on about 100 different pharmaceutical programs in sort of rare diseases, sort of cancer cures, these kind of things. Now, not all of them are going to work, but through all the stages that those guys are doing it, they will get, you know, they get the revenues for the instruments, and then they will get some milestones, and then if the drugs are successful, they get some very big royalties. And we're getting to the point where they're getting more of these drug programs, they get more partners, and then more of them are moving closer to the point where they deliver. And the share, I mean, I first bought them on the Crux UK special sits at £1.80, and they went down to 90p in the difficult market. The business was delivering, but then we saw some of the US crossover investors come in, which, I mean, basically what they do is they're scouting around the UK and Europe for interesting assets that are far more highly valued in the US. So the money, there was quite a bit of money went in at 130, I think last March, I think it was. And then we had some money going February of this year at £7, and had just done a NASDAQ listing at that's part of 10 quid, I think it is. I think they're about 11 or 12 quid. But they, you know, they've gone up a lot. They're cheap relative to other things on the NASDAQ, but that's often the dilemma we have in the UK. Things usually are cheap relative to NASDAQ. But I think that's where the UK can be really interesting, is you can buy the growth companies that are growing the same rates as these US things, but often, you know, maybe 25-30% of the valuations. And just Maestrano, it's quite early, but they have a technology like a LiDAR they put on the front of a train, and they've got the back office systems which enables the railway operating companies to tell whether the rail has moved. You've got encroachment of vegetation, whether the tunnels are moving. So it compares it against where it was before, which is obviously a great saving over doing those sort of things manually, which often may be subject to not doing it properly and or just huge cost. So they started it off in Australia. So they got contracts in Australia. They made really good progress in the UK, and they just started very recently. They've got initial contract in the US, but if you read their statements, they're talking about very strong levels of interest for that product. So it feels like they've done the heavy lifting there in developing the product. People are seeing it and using it, and there could be a whole lot more development there. So revenues are small, but not tiny, but growing quickly, and it fits into that artificial intelligence, real world solution that's at a commercial stage. So yeah, I mean, those could be 30, 50p. I mean, but sometimes these things capture the imagination. You see that quite a lot. There's quite a lot of other companies out there that are worth a look. That things like seeing machines and these kind of things that I don't own, but where you've got the US comps that are so much more highly valued.
And how do you sort of like kick the tires on something which is early stage to see whether it works? What sort of, I mean, with regards to the due diligence, do you bring in your own independent experts or something to give a sort of like their view of whether the technology is going to work or not, or what sort of like the technical risk is or launch risk of this? I mean, how do you actually sort of like size that one and price it?
Yeah, so in sort of healthcare, what I'm looking for is some of the pickup from the customers. So I mean, the due diligence that a corporate's going to do, a big corporate buying a small technology for a small company, is far more due diligence than I do. If I went to a third party, you'd spend a lot of money and get a tiny fraction of the difference. But it's something like a Maxcyte. The people that are using their products and things like CRISPR technologies and a couple of the other ones were companies formed by people that have won Nobel Prizes for gene therapy and things.
Yeah.
The hottest of the hot sort of companies in that sort of space who should know what they're doing going into commercial terms with little old Maxcyte was very positive. I mean, also supplying 20 of the world's top 25 pharma companies, it might be some of the smaller divisions, but that's pretty strong endorsement. So I've learned over quite a few years that when somebody comes to you with an idea, we're going to do this, we're going to build a mine, it's 10 years away, that's probably too early. But when something's developed a few years and then you start to get other people looking at it and coming in and supporting it and maybe giving them royalties and things, then you've got a much better chance.
Yeah.
Still not necessarily widows and orphans, but you have a much better chance. Yeah.
Those customer endorsements basically mean that if the experts in the industry like that technology, then there's a good chance of it coming to market, I imagine. Yeah, I think so. I mean, often the due diligence means that they are actually calling a product off to people as well. Yeah. Okay, brilliant. Well, thanks very much, Richard. Fascinating portfolio and selections, as I say, across a whole group of sort of different. You've got turnarounds, you've got value plays, you've got sort of like back in the right management team, and a number of sort of like say hidden gems there, hopefully for the future. So just before we finish, though, if anybody wants to invest in the Crux Fund, how best to do that? Is it best to sort of like go on the website or contact you, or how? Well, we're not allowed to sell directly to consumers because obviously people need to see their financial advisor and make it specific to their own conditions. Fine, got you. But were they interested about the Crux UK Special Situations? It's available from good platforms, all good platforms, retail platforms, or you can actually go on our website and there's a telephone number you can ring up and buy it, or you can do it through the web. Brilliant. Okay, well, look forward in touching base in about 6 months' time. And I mean, you've got some fantastic opportunities there that investors can sort of like run the slider all over. So thanks very much for your excellent insights and time, Richard. Well, thanks for the questions. It was very, very well informed. Thank you. Thank you ever so much. Bye-bye.